Well, welcome everyone to our third and our final investment webinar series where we're teaching you the steps to start investing. He's on mute, perfect. But we're teaching you the steps to start investing. So we are very happy to again introduce Blake. Blake is going to be our financial advisor. Blake has many years of experience in the field, and today he's going a little bit over what does it look like to start investing. He's gonna get a little bit more hands-on and showing us a lot. So I hope this is helpful and good education and knowledge for each and one of you guys, and I hope you guys can use this in your daily life or when you're ready to start investing. So Blake, you're welcome to take the floor, and we're excited to hear what you got for us.
Awesome. Thank you, Rainieri. So after our last webinar, we heard that we wanted more practical education. You know, we talked a lot about why we invest and some concepts around investing, but like most people, as you get involved with something and you actually go to do it, it's really helpful to have some idea what it looks like and kind of what steps you would take and what the questions mean as you're getting something set up. So what I'd like to do today is spend some time actually looking at signing up for a robo-advisor. I'm also going to walk through a couple other pieces of information about different types of retirement accounts and a little bit about 401ks and investment selection. So, well, a little bit. So we'll kick that off. And certainly if we have questions along the way, feel free to ask. I'm happy to answer those. So before we jump into any of the specific topics, just a good reminder is when you're starting to invest, you should already have reached financial stability and we're saving extra funds. And there's a couple exceptions to that, especially if you're in your 20s and just entering the workforce. It's especially helpful to be investing, especially if you're getting a match in your employer's 401k. Like if you're freshly out of college, it doesn't hurt to start investing right away. But for most people and even folks in their 20s, it's a really good idea to get that emergency fund set up first so that should you need you know, some funds for something, you don't have to come tap your investments, because often your investments will be in a bad spot to be sold when you're having your emergency. Most people are going to run into those emergencies and needs for those funds. Something like a job loss or a recession, probably both in combination. And that's also when the stock market's crashing. So you really don't want to be saving your emergency funds in the stock market. And then the second piece is once you have that emergency fund, it's almost always the case. There's some exceptions, but they're few and rare, where your 401k is the best place to start. And the reason I say that is because generally you get a match. Not every 401k has a match, but most of them have at least a 3% match. And if you're any age and working and you have a 401k, even with a 3% match available to you, that is the first place I would start investing. That you're doubling your money on day one, which is a pretty darn good deal. And often there's better matches than 3%. I've seen the best I've ever seen was a 200% match on 10%. So if you put in 10, the employer put in 20, that's a pretty amazing. So I've never seen anything that good. It was like, I think the University of Michigan. So in any case, I do want to talk a little bit about 401k investing because it's really pretty straightforward and simple and doesn't require too many too much information about it. I'm just going to pull up a fund here. And I think we talked about these last time a little bit, but I'm just going to touch on them again real quick. But
Hey,
right
Blake,
here, yep.
but while you look for that, there's Justin.
Oh,
Justin Ibn has a question, and I also have a question for you too.
and then Rainier, you had a question too?
Yeah, and it's pretty much just to give people an idea. So the very first thing you mentioned was savings, right? We want to have savings before we start investing. Now, 401k is a form of investment. Is the very first form of investment that you're mentioning. Is it something that I should also have savings first before I start, since it's from my job and sometimes they match, like you mentioned?
If you're getting a match and you're young and on your own, I would go ahead and start utilizing the 401k. When I think of someone who shouldn't, it's maybe a small family with 2 kids. They're just finding out about this, trying to get into a good spot with their finances. They should focus on stability first and kind of the wellness, get their budget under control, have an emergency fund. Like, it's important to invest, but if you're investing at the cost of your emergency fund, you're going to run into an emergency. And then you're going to be in a bad spot where you got to sell investments that you didn't really want to, and
Okay.
probably at a bad time. So that cover it for you?
Yep. Thank you so much for answering that
Perfect.
question.
Absolutely. So when you do go to your 401k, you're probably going to run into a couple different ways to invest, and maybe 3 or 4, but essentially you're going to have one option, which is using a life cycle fund. Fidelity brands theirs the Fidelity Freedom Fund, and then there's a year in it. So the 2040 is a fund designed for someone who's going to turn 65 at about the year 2040. You would also find this from other firms. Like, a really common one to find is Vanguard. And if we go in there, here's the Vanguard 2035 fund once it comes up. And this would be for someone retiring about the year 2035. But you're going to see something like target retirement, and most importantly, a year somewhere in the future. That's how you know it's a target retirement fund. The reason I like these so much in a 401k is that you don't really have to think about how to build a portfolio. These funds will build a full portfolio for you based on someone who's retiring or going to turn 65 about the year of the fund. Now, if you were going to retire late at 70, you could line up the year that you turn 70, or vice versa if you're going to be younger. But if you're like me or someone in their, younger than me, you probably have no idea what your retirement year is. And 65 is good enough guess at this point. So if I was going to invest in a 401k, I'd look for the ones that are listed with a year in their name, and just invest in the one that is closest to age 65 for you. Adding multiple ones of these together doesn't actually make sense, because they're typically a 2040 and a 2020 are going to have the same investments, but the 2020 is just going to have more bonds in it and more of the same bonds that a 2040 might, and just have less stocks. So there's not really a different portfolio, just different levels of risk based on your age. So you should, if 2040 is close to you turning 65, that should be the only fund you need. The other options are generally a list of different investments, which if you picked one from every category, you would be able to build a portfolio like this. But then you have to decide how much goes in stocks and bonds and do the rebalancing. And really, it just makes sense to use these. There might also be self-directed investments where they give you a brokerage account. You can go trade stocks. I wouldn't do that. Not with your important core investment funds that you're going to use for retirement. This is the way I invest my retirement funds. It's not in a freedom fund, but the same style of investing. And, I'm happy with the returns I get, knowing that I'm not also at risk of losing 50 or 60% if I make a wrong decision. This is basically going to track the economy. So that's really kind of all you have to think about in 401ks. And that is one of the other nice things beyond the match, is that your employers are required by law to act as a fiduciary, meaning that they have to put your interests before theirs, which is maybe not realistic entirely. But what it means is that they can't go put the entire cost on you and end up charging you 2% for your 401k or 3% and like revenue off their employees utilizing the 401k. They also can't design the plans that only the high-end folks making the most get use out of it, and everyone else can't really make use of it. So like, it's going to be a reasonable plan 99.9% of the time with reasonable fees. And then they also have to select the investment menu for you. So there isn't a bunch of wild garbage in there, and there's not scams. There's not, super risky investments inside of it. Something like a freedom fund is kind of mid-level risk, even if it's a more aggressive one. And that's a big part of why I like them. The other thing that you can do is you can usually contribute both Roth and pre-tax to a 401k. So it's super helpful to be able to do both. A Roth is where you put money in after tax and you get it back tax-free, with the growth being tax-free too. And the pre-tax, you do not pay taxes on today. You pay taxes when you take it out, and the growth, of course, is taxable too. Rainier, you had a question?
Yes. So before we move on, because I know a lot of people are also self-employed and they don't have an employment who's going to contribute or offer the 401k. Vanguard, when you talked about Vanguard is also something that we could use for those self-employed people. Is that correct? Where they can start contributing, or does not work like that?
Yeah, so there are small business retirement plans. Let me pull them up here. Business retirement. And part of the hard part about talking through this is there's a bunch of them. But yeah, here we go. If you're self-employed, you have an array of different options that have been created for you. And it kind of depends on your business. So if you are the only employee, then a self-employed 401k or a SEP IRA can make sense. The owner can contribute, an employee can contribute, and if you are the only employee, you can contribute both as the employer and the employee, allowing you to contribute up to $32,500, which is more. Well, and that's just for the employees. You could do almost $80,000 a year as the employer and employee, which is really what makes these great. The SEP can do almost the same amount of contribution limit, but what catches a lot of people on the SEP IRA is if you have employees, only the employer contributes. And if you contribute 10% to your own, you have to contribute 10% of your employee's salary too. So SEPs work great with sole employers and really if you're by yourself, a self-employed 401k is probably better. But like if you and your spouse were doing something together, it's not a big deal to also contribute for your spouse, right? So you could both do 10%. If you get to the Fidelity Advantage 401k is kind of a little bit different. This is basically their basic level 401k like a normal corporation would have. So we're going to skip that one. But the simple IRA is often used for businesses that do have employees, and there's a number of them. You typically wouldn't open this if you were a sole proprietor. You'd go with one of the first two. But with the simple, you can have everyone come to the Fidelity, Vanguard, Schwab, wherever you set it up, and they can open simple IRAs under your business's name for themselves, and then you contribute for them. And it's really relatively inexpensive compared to setting up a 401k. And, most people make good use of them. Really, the downside is there's some lower contribution limits. You can see that like it's 22,100 versus 32 on these. And there's some oddball withdrawal requirements too, but only in the first 2 years. So they're a little bit less advantageous than the other two, but when you have like 10 employees, this is a nice middle ground between something like a SEP IRA and a real 401k. It would also be good to know that you have as the employer, you have to either contribute 2% of their income or do a 3% match, whether you like it or not. That's a requirement of setting up a simple IRA. There's actually several other things up here, like you can set up your own pensions. And if you're a successful business owner, like not just successful, but let's say wildly successful, and your net profit that you take out of it's $1 million or $2 million a year, there are all kinds of things that they can do around retirement accounts and hiding as much of that money from taxes as possible. But that's not something we're going to cover today. You go find a wealth manager if you need that. I would be happy to meet you. So that's kind of an overview of small business retirement plans. And the takeaway I would say is it really depends on your business structure and whether or not you have employees. And you'll need to talk to someone to figure out which one's right for you. Go ahead, Justin.
Yeah, so I just had a meeting at my so I'm a contractor for my first job.
Mhm.
And then my second job, I'm an employee, and so they just brought someone in to present their 401k for that company. So it's relatively new to me, well, very new to me, although I've heard, about 401ks all my life. This is the first time I've had an opportunity to engage in one. So they do have a person that I can call to get advice, but they're asking that, the initial setup, that I do that all myself. There is a advising, I'm not sure what the exact term is, but there's an advisor for the investment part of it. And one, I think, ends up basically being a robo-advisor initially. So that's free. And then when you reach, I think it's 20,000 and up, then it's like 2% fee, and which seems okay and reasonable to me. And then also their match is starts out at either 2 or 3% after the first year for the first 2 years, and then I think goes up to 4 or 5, somewhere around there after I think 4 years. I'd have to have all the paperwork in front of me, which I don't right now. But anyways, I guess what I'm getting at is this is something I should engage in. This would be a safe and reasonable way to start investing. You agree?
In general, yeah, I'd like to get a little bit more detail, like who the investment company is and stuff. It's a little interesting to have the investment advice built into it. You don't always see that, and it's certainly not with charges. However, I guess the first question is, do you remember who the investment company was?
I think I want to say Century, but I don't think that's it. I have the packet but I don't have it with me. It's got all the details
Yeah.
and the advising portion of it, which is separate,
Okay.
but is built into it if I want to use that.
That's fair. So
Yeah.
if you're not hitting that maximum, then you can put as much as you want in, as long as you can afford life on the other side.
Okay.
I have met people that were contributing so much that they were struggling, and I'm like, how about we just do a little bit less over here,
Yeah.
and you'll be fine. And because you really over saving doesn't help a ton either. You just end up with a bunch of extra money in tax issues. So,
Yeah.
but 10%, especially at a second job, isn't going to cause you any trouble.
Okay. And also, I was wondering, I know you can do a mixture of pre-tax and Roth. I'm more inclined towards Roth, just going all in on that, also because of my age.
Mhm.
So, and then, being as that helps mitigate the fluctuations of inflation and so on and so forth. Does that seem reasonable, just to go pretty much all in on the Roth angle?
That gets to be like 100% Roth versus another mixture would be pretty specific. However, and we'd have to get into a bunch of personal details for me to say for sure which is better. However, I say a good starting point for anyone is half Roth, half pre-tax. If you're not struggling with how high your income is and how high your tax rates are, doing 100% Roth is fine. The only people that really shouldn't do Roth are people making $500,000 a year or more, and none of us are making $500,000 a year. So I'm 50-50 in my accounts. But doing 100% Roth is perfectly reasonable, especially if you're lower income and younger. Like someone in their 20s making 50,000 a year or less right now, 100% Roth makes great sense, because you're really not saving that much on pre-tax. If you're 60 and you're going to be retiring in a few years, then Roth makes less sense, especially if your income's a little bit higher, because you're going to be able to take or put money in, avoid taxes, and then in a few years you'll be able to pull it back out at a lower tax rate. So that's where the pre-tax makes sense. And if you're looking at a whole career, I like 50-50, but I think it's for you absolutely 100% Roth. There's nothing wrong with that. And really anyone could do 100% Roth their whole career. They're probably leaving something on the table as far as how much or tax efficiency.
Right on. Thank you.
Absolutely. So once we're past the 401k, that's where we get into the, like, what if I'm already contributing to a 401k, or what if someone leaves me some money for retirement, or, you inheritance, I should say, or I don't know, you win the lottery. But if you win a big lottery, go find a real wealth advisor. Like, if you have millions, don't do a robo advisor. But if, let's say, you won 100,000 or 50,000, you pay off your debts, you make sure you're fully funded in your emergency fund, you've got 60, 70,000 left. How do you go about investing that? So you can't take money out of pocket and put it into a 401k. You can put money into an IRA or a Roth IRA, but only 6,000 or 7,000 a year, depending on your age. So it wouldn't really allow you to invest that whole chunk of funds. So that brings us to and it might be savings for retirement, but we call them non-retirement accounts because they're not an IRA. But another way to look at it is a regular brokerage or an individual or joint account. There's lots of terminology that could mean it, but basically we want an investment account that's not an IRA, because the IRA, and really for a 401k or 403b, what those are referring to are special tax rules. And if you have special tax rules, you probably can't take the money out as you need it, and you can't put as much money in as you want. You have all these rules around it so that you get the special tax deal. So in this case, if we have a chunk of money, or one of these other reasons where an IRA, a 401k doesn't fit your situation, or let's say you're not saving for retirement. Say you want to save for a car or a house down payment, you're not going to be able to pull that money out until you're over 60, which might be a bit too late. So if you're looking for a non-retirement investment, I would start with robo-advisors for a couple of reasons. Robo-advisors, number one, make selecting investments easy. And that's especially helpful when you're looking at, say, a 401k. You have like, I want option a life cycle fund, or I want to build my own portfolio, or I want to do something complicated. If you roll up to an individual non-retirement brokerage account, you're going to have tens of thousands of options. When you count up all the mutual funds and all the ETFs and all the stocks in the world, there's well more than 10,000 of them out there. And one of these accounts is going to give you access to all of that and maybe more. So it can be a bit overwhelming to just choose something, and you don't necessarily want to copy what you're doing in your retirement account, because it can cause you tax issues even if you don't sell the investment. So the robo-advisors, and I've got a NerdWallet article up here that I'm going to paste into the chat for reference. And these guys cover a number of different firms, and I'm going to focus on Fidelity because I know the website really, really, really well after working there for 16 years. They also, their robo-advisor has no fees on balances less than 25,000 and no minimum. So you can start one of these today, put $1 in it, and it will invest it for you. I'd probably try to get at least 100 in there to start with so they could buy multiple things, but they don't require it. But if you look down here, like at Schwab, Intelligent Portfolios, the minimum's $5,000, but they don't charge any sort of fee, management fee on it. So there are some underlying expenses. It's like 0.12% right now, but basically free. Where Fidelity has no underlying expenses, but once your balance goes over 25,000, they're going to start charging in this 0.35%. So all of them are very reasonably priced. I would not choose based on the costs. I would look at the minimums, consider where you already have accounts. If you already have a 401k at Fidelity or Schwab, maybe use their option just to keep them both at the same firm. But what I'd like to do is walk through kind of the first few steps of setting up one of these accounts and talk about why they're asking the questions that they're asking. And it'll also help you have a good idea of how to walk through this. So actually, let me go back a step. So if you want to get to Fidelity Go, the easiest way to get there is you just go to fidelity.com, and I just come up here and type Fidelity Go, hit enter in the search box, and it's always the first option, Fidelity Go, right here. So once you're in here, the whole page is talking about what I've been talking about, but there's a get started button here at the top, and Betterment or Wealthfront or Schwab's Intelligent Portfolios will have a similar way to get things started. You have to just go to their website, and there'll be a way for you to get the ball rolling. So I'm in this first screen here, and it's the first thing it's done is ask me 3 different questions. Am I saving for retirement, for healthcare, or something else? There's a very good reason for that. They want to figure out if we're going to be investing in an IRA, a health savings account, or a non-retirement account, that third one I was talking about. So, and you could do something else, do a non-retirement account and actually save for retirement. That's not really what they're asking. What they're asking is what type of account do you have? I'm going to go with the something else. And then the next question here is, am I opening an account for just me, or is it a joint account? So an individual account, just you, is one thing. I mean, that's pretty straightforward. A joint with rights of survivorship is one where typically you'd open it with a spouse, and if one of you passes away, the other one automatically owns 100% of the account. There's no beneficiaries, no going to court. You just own the account once they pass away by yourself instead of jointly. Joint tenants in common would be like siblings, maybe, where you own the account 50-50, and then if one of you passes away, half that account's going to go to their beneficiaries. So I'm going to choose the individual here, and it's going to ask me when I was born. And do I have a partner? Yeah, they were born in 1985. So the reason they asked this is partially because if we're under 18, we shouldn't be doing this. We can't open accounts if you're under 18. But also, like, if there's a retirement goal out in the future, they know roughly when you're going to get there. And also, when you sign up for any of these accounts, they're going to ask your social, your date of birth, your all of this information, your employment information. It's required by the government for them to gather. It's called Know Your Customer. It's basically anti-fraud stuff. So they're going to ask a lot of questions. So I've got the years we were born, and then you have annual income. So I'm just going to put some numbers in there. And it's going to ask your income mostly because they want to know how stable your financial situation is, but more importantly, what kind of tax brackets are we looking at? Let's see here. How much money do you need to reach your goal? Let's say I'm trying to save 50,000, no, 500,000, and we're trying to get there in 15 years. This goal, or these questions here, are probably the most important ones. They're asking, how much are we going to need to save, and how long do we have? And those are going to be, the how much can we save is pretty self-explanatory, but how long do we have is going to be connected directly to how aggressive we can be. So, and essentially, if you're taking risk in the stock market, the longer that you have in the stock market, the more certain we can be that you'll have a gain. There's actually, with a mixed account of stocks and bonds, like a 70-30, there has been no 10-year period where that hasn't been profitable in our, American history, back to usually 1928, before the Great Depression, is where the data runs out. So this is actually really important. Are we 30 plus years? Are we 15 years away? And then as we approach it, this program would automatically make you more conservative because, if you get to your goal and then suddenly the market crashes and you lose 50%, suddenly your goal shouldn't happen today and you don't have the money for it anyway. But let's take it out to maximum and do 30 years. That'll allow it to be more aggressive. An initial deposit, let's say we put in 1,000 to begin with, and then every month we're going to put in 500. I'm just making these numbers up as we go. Now it's asking about my comfort level with risk. And this is actually nice. It didn't used to ask this. I think it's really important to ask how comfortable you are with risk, because often your financial situation is a lot of what dictates it. And if people forget to ask this, and this happens in the industry, you can easily have someone who financially could take all the risk in the world, but if they're going to, have a really hard time watching the numbers go down at all, you probably shouldn't have them in the stock market. You've got to be able to allow it to go up and down, because if you sell it every time it goes down, you just never make, you'll almost certainly force yourself to lose money that way. Me personally, understanding the markets like I do, I'm 44, so I'm not young anymore, I guess, but I'm still at least 20 years away from retirement. And I know full well that we're going to see some big crashes between now and the end of my career. So I'm a 10 out of 10. And with that information, 10 out of 10, we're 30 plus years, we're going to be saving for, a decent amount for the goal. it's saying that the mix is going to be 85% stocks and 15% bonds. And if you add all these up, you'll realize it adds up to 101%. It's just a rounding error. But essentially, there's a little bit in cash too. If I was less okay with risk, it makes an adjustment here. But you notice it didn't go all the way down in risk to like a 20% stocks. I mean, even if I go to a 1, that made a little bit of a difference. This is a 40% stock mix. A 3 gives me a 60% stock mix. And as soon as I get to 5 or higher, we're in that 85% again. That's because of how much time we have and the income, like it's to the investment. Well, it's not to anyone in particular, but when you're scoring these, essentially saying that you have 30 years is going to make you fairly risky. If I went back and changed nothing else, left this at 10 and said I was going to need the money in 10 years, it would automatically get more conservative, because over a 10-year period, taking maximum risk doesn't necessarily mean you'll get a good return. It might destroy your return depending on the 10 years. So the other thing I would say about the 1 to 10 question is, and you'll see this even if you go talk to a live person, they'll usually ask you some version of this question. This is your comfort level with change in value. No one's totally comfortable with their money going poof and vanishing. I haven't met anyone yet. So saying 10 out of 10 doesn't mean that I am comfortable rolling the dice and maybe losing it all. It just means that if it goes up and down and up and down, and one of those downs is 50%, like a 2008, I'm going to stick it out. And if that's what you did in 2008, you did a lot better than someone who bailed out. That's a 10 out of 10 on risk. Someone who gambles all their money on gambling, or like, I don't know, one stock that's an IPO and they put all their money on it, that's not a 10 out of 10 at a risk. That's someone who doesn't know how to invest. So in any case, this is where it assigned the mix. And it should, excuse me, just a moment, wrong pipe. All right, I think I can talk here. There it goes. So it's showing us the suggested strategy and some of the answers to the questions, and then allows me to jump right in here and create the account. And that's when they'll start asking you the personal details that they have to open the account. But you'd be able to redo this and change it if you wanted to. And with a robo-advisor, it's going to come to you once a year, probably via email or a reminder. And you're going to go back through these questions and update them every year. And as you get closer to your goal, or if your risk tolerance changes, it would automatically adjust the portfolio for you. Justin, go ahead.
Yeah. So I was also thinking, aside from the 401k, which I can take with me, I do plan on probably relocating. And most places have a 401k. So, but I was also thinking of doing what you're showing now, and diversifying a little bit with doing a robo-advisor, and just checking it out for a year or so and seeing if I want to, bump things up a bit. Does that sound like it's too risky, or should I just keep it all in the 401k?
No, it's certainly reasonable. In fact, I often tell people that they want to save in all three types: pre-tax IRA or 401k, Roth 401k or IRA, and a non-retirement account. And the reason for the non-retirement account is, what if you want to retire at 55 or 58, or you just need some money for something along the way? This is all accessible with no penalty. You will pay some taxes, some capital gains taxes, but it's accessible without a penalty. And the penalty is 10%, and then you have to pay income taxes on it. And, like that Roth money's growing tax-free. You really don't want to touch that. You want that to grow. This is the account you'd come to first, to utilize prior to retirement for something that isn't retirement related, or like once you get into retirement. The really nice thing about these is you can take big chunks of money out of them without running your income up and the income tax along with it. Same thing with a Roth, but it gives you flexibility. Like if someone comes to me with all three types and says, I need 150,000 a year to live, I can basically make it look like they earn 50,000 a year, because that's what comes out of the traditional IRA. And then we take the rest of it from this account in the Roth, and their only income is what comes out of the IRA, the traditional IRA. And then, I've done that a number of times, especially for people who were retiring before 65 and can't get Medicare, so that they can get the ACA subsidies. So having all three gives you some flexibility.
Okay. One more question. If I were to go this route, to have something to like pay my mortgage off, or, I mean, that's really kind of what I'm thinking, is because I'm looking at the home buying process, starting that within the next year.
Mhm.
And I'm just thinking further ahead, I want to be able to pay that off. But if I have something like this that's has, growth to it, that could help me out more on the back end as far as taking care of that mortgage, either earlier, or maybe, I decide I want to retire sooner, or I just want to have something to supplement my mortgage payment when I'm retiring. I'm just
Right.
thinking ahead about being able to make sure that that mortgage is paid for and taken care of, even if maybe my income decreases, something to that effect.
Yeah. So I think that's perfectly reasonable. And really anything's kind of reasonable with these as far as the goal goes, because there's not anything forcing you to do something else, like not withdraw it earlier. So like, even if you wanted to just go to Vegas and blow it, this would be the account to pull it from, especially if you're not 60 yet. I think for the house, one of the nice things about mortgages is that inflation happens and your mortgage payment doesn't change. So if you get out to retirement, you might find that Social Security easily covers it, or adding, you could pull monthly out of this account what you need to pay the whole mortgage, because it's maybe $3,000 a month now, which is tight, but in 20 years, it's going to be like more like it's $1,500 a month. So
Okay, gotcha.
so it may not make sense to pay off, I guess, at that point. But this account gives you all of those options, where there aren't a bunch of bad ones, like there are with IRAs, because they're really trying to box you into using it for retirement, so that it's incentivizing you to save for your own retirement.
Gotcha.
So,
so what you're showing us here, I could just go in and kind of poke around and get some numbers, and then like, okay, well, I'm going to do like what you plugged in, initial deposit of 1,000, and then dedicate, at least for the moment, 500 a month, and just get going on it.
yeah.
And see.
Like
And
I've
then
done
I can
half
always
the
include.
setup here. If I did create account and entered my personal details, at the end of it, there would be an account ready to receive those dollars and start investing. And part of the setup process is connecting it with your bank so you can do direct deposit or whatever. And then you're up and running. It takes no more than 30 minutes, maybe. I could probably get through it in less because I've done those questions thousands and thousands of times for other people, so I can run through them pretty quick. But even if you've never seen them before, a half an hour from I want to invest to having an account open is nothing, especially when you consider that it's selecting the mix for you and everything. The other nice thing about the robo-advisors is that you just deal with it as a deposit and a withdrawal. If you have a brokerage account where you have to place the trade as well, you can make a deposit. And I see this all the time. And just saw it over the weekend with a friend of mine who I helped her set the accounts up. And I guarantee you, I said, now next year, when you make your deposit, you got to remember to place the trade or it's just going to sit in cash. And her IRA had 2 years of cash sitting in it. So, she made the deposits, which is good, but it sat in a money market and missed out on 15-20% of returns because she forgot to place the trades. With a robo-advisor, it just invests when you put money in it. When you need money out, it decides what to sell and then it pulls it out. So you don't have to think about that layer of investing. You can just put money in, take it out, and it deals with the rest.
Okay, and then at a certain amount, then it starts there's a charge for these, right?
Well, this one wouldn't start out with a charge, but once you get to $25,000, it charges 0.35%. But let's do the math on that real quick. So 25,000.00035. So it'd be $8.75 a year. That's not too big of a deal, right? Yeah. So, I mean, it would be some real money once you get up into the millions, but at that point, you probably want a live advisor anyways, because there's other things to think about. But yeah, absolutely. And that's why the other reason I like robo-advisors so much is there isn't this intermediate time period where you have to figure out what you're going to buy. That's where I see a lot of people who are initially excited to get invested. They'll get in here and they'll get bogged down in all the potential decisions for which mutual funds to buy or which stocks to buy, or they just buy a random list of stocks and mutual funds they got off some list on the internet, which is just about as good as not investing at all. And, there's just so many things. So this cuts all of that out. It asks you the important questions, and then you just deal with it in deposit and withdrawal. And the fact that it's free for the first 25K is a huge, huge plus. So that's a good place to start. And if you want to look at the other options, like Charles Schwab's a good one, Vanguard's a good one, Wealthfront's good, Betterment's good. All of them have their pros and cons, but I just know Fidelity the best. And knew I could get through this part of it without it making me sign up. So in any case, I think all of them are good, but I do think Fidelity's especially good when you're first starting off because of the no fee under 25K. That's unique to the Fidelity one. So let's see here. While I'm at it, if you decide not to go with the robo-advisor, it's really not that much more difficult. You just come right up here on fidelity.com or, again, schwab.com or whatever. There's always going to be like a login and open an account somewhere because they want to make it really easy for you to give them their money. That's how they make money. So if you open an account, you can come in here, open an IRA. In just about as much time as it took me to run through the other questionnaire, except for this one's not going to ask you those questions because all you're trying to do is set up a account at essentially a bank or somewhere, in this case, it's at Fidelity. And this is what it's going to ask you. First, middle, last, social, date of birth, country of citizenship, mobile number, email. By the way, if you're a member or if you're not an American or you're anybody living outside of the United States, this all gets wildly more complicated. So you probably are an American citizen, or if you're not an American citizen, you want to list your real citizenship and then where you live needs to be in America. But you answer, this is contact info plus your social date of birth, an address. The next page would ask us employment information and probably have us set up EFT, and then you're done. If I was logged in, it wouldn't even ask this. It'd just be like, are you sure you want an IRA? And I click yes, and then it would open. So it's really, really easy to set up accounts and get the ball rolling. The hard part really is just like actually doing the deposits, because it's money, and then choosing the investments, which a lot of that's taken away by the robo-advisor. Go ahead, Justin.
I think I didn't get fully absorbed when you were starting this out. So you went to fidelitygo.com, and that brought that up. Where do I go if I want to choose using Fidelity's robo-advisor?
So what I do, and there is several ways to get there, but the most reliable way is you just go to fidelity.com, and then in the search bar on fidelity.com, I type Fidelity Go and hit enter.
Okay.
And it'll be the first match.
Okay, so it's Fidelity Go in the search once you get to fidelity.com.
Yeah.
Okay.
Yeah. Okay. Go is the product name, essentially. So, yeah. You kind of have to search for Fidelity Go, though. I don't think it'll actually do a search just for the word go. It might work. Yeah. But anyway, that's the easiest way to get there. You can probably get to it through like the wealth management or maybe the investing tab, but this is way more direct to just search for it.
Okay.
Cool. So that's actually everything I had, and I was pretty accurate, right? It's kind of crazy. I was saying this is maybe 60 minutes, and I think we started at 7:06, and here we are at 7:05 or 6:06. So right on the money again. And we've got an hour and a half, so I'm happy to answer any additional questions you guys have. But I'm pretty, I think we covered that pretty well. And I think that robo-advisor and seeing how to launch it is important, and knowing why they're asking the questions really helps. If you were to walk in and sit down with a Fidelity or a Schwab advisor and have them manage your money, they would ask you a similar set of questions, maybe even the same set, when they would be looking for the same information to figure out how much of a risk you can take.